Hello. Guys, we might get a start back on our next afternoon session. So just before we begin, I've had a few questions come over about the slides and whether they're going to be made available today. They will be on the website, apart from the APRA ones, but they will be online, and there's a video conference happening, so that will be available as well on the FSAA website for those that have asked. So next up, we have discussions of specific topics by William Frawley from PwC and Michael Molloy from RT Health. This is an interactive session, so please do send your questions. We won't wait until the end to ask them, so please do send your questions, and then I've got a mic now, so I will ask the questions. Welcome to the stage.
Hi, so I'm Will Frawley. I'm from PwC. I sit in our insurance practice in Sydney, and I specialise in IFRS 17, so I'm in our central team doing that, helping, I guess, a number of clients along their 17 journey. We're here to discuss specific terms, which Mike will delve into. A lot of his content has been covered at a high level throughout the day, so it is a discussion, so we do encourage participation, questions, which we'll try and kind of go through on a live basis just to make it more interactive. And some of the slides do have a lot of content in. They're going to be obviously made available on the website after events, so we'll be calling out key messaging and not really going into every line covered in the slides. Michael.
Fantastic. Thanks, Will. Well, as Will mentioned, my name is Michael. I'm currently working in private healthcare, but prior to that, I was working in life insurance, prior to that, reinsurance, and when I left audit practice, I joined general insurance. So let's get into what we're going to be talking about here. Now, as Will mentioned, we were talking about discussion on specific terms, but there's two key areas we're going to be talking about this afternoon. Two key areas we're focusing in on. The first one is the contract boundary, and embedded into that is the PAA eligibility. And the second thing is the contractor aggregation. Now, I'm aware that this has been talked about earlier during the day with some excellent presenters, but when we're going through sort of more detail, and as Will said, this is an interactive session, so if you have a question or something you'd like to raise, please feel free, because that's the purpose of what this session was basically about. Okay, so for those of you that are very interested in the paragraphs in terms of what we're referring to, there's a number of key paragraphs that we're going to be referring to throughout the session. The first one is paragraph 34, which refers to the contract boundary of an insurance contract. We're then going to be looking into paragraphs B65 and B66, which looked at the cash flows surrounding that contract boundary. We'll then be looking at paragraph 53, which talks about the premium allocation approach that we looked about earlier this morning. And finally, we're focusing on paragraphs 14 to 16, the levels of aggregation that you're required for your insurance contract. Okay, so why is this section sort of so important? Well, effectively, this represents the start of any IFRS 17 project that's going on. We'll be talking through what are the first steps that you need to do to start a project surrounding this, the implementation of this particular accounting standard. We'll highlight some of the complexities and subjectivities around IFRS 17. We'll talk about what you need from an actuarial team, include potentially your appointed actuary, and finally, when you need to engage your external audit managers and partner in relation to this. Okay. So the first thing we need to have a look at is the contract boundary. Now, normally I don't like reading off the slides, but I will in this scenario because I think it's actually very important what this paragraph actually says. So, contract boundary is defined in paragraph 34. Cash flows are within the contract boundary if an insurance contract if they arise from substantial rights and obligations that exist during the reporting period in which the entity can compel the policyholder to pay premiums, or in which the entity has a substantial obligation to provide the policyholder with services. A substantial obligation to provide these services ends when A, The entity has a practical ability to reassess the risk of a particular policyholder, and as a result, can set a price or level of the benefits that fully reflect those risks. Or B, both the following criteria are satisfied. The entity has the practical ability to reassess a portfolio of insurance contracts and that contains the contract, and as a result can set the price or level of benefits that fully reflects the risk of that portfolio. And the pricing of the premiums for coverage up to the date when the risks are reassessed does not take into account the risks that relate to periods after the reassessment date. So there's quite a few words in there, but what are the key words that stand out? The first couple of key words are substantive rights and obligations. So what do we mean there? When we talk about substantive rights and obligations, we're really talking about the rights, i.e. revenue or benefits sort of coming into the insurance entity. Or alternatively, we're talking about benefits or claims going out in a way of obligation. Now, the contract boundary ends when that obligation finishes. So what are the scenarios around that? Well, effectively, one key thing has to happen. And that is the entity has to be able to reassess the risk in regards to both the price and the benefits. So if we think about this in a more practical sense, someone sort of comes in and gets underwritten for a type of insurance. At what point in time can you then reassess that particular policyholder or that particular group of policyholders in regards to either the price or adjusting for benefits? And as we sort of come on board, when we're going through some scenarios that will look at exactly how this works in practice. But overarching the whole contract boundary is the two words cash flow. So it's really important to understand what we mean when we talk about cash flow. And to do that, we now need to refer to paragraph B65. This is another very important paragraph that we need to refer to when looking through the contract of a contract boundary. Now, what paragraph B65 refers to is what cash flows are included in the contract boundary. And you can see there's a number of key ones. The first one is premiums. And again, we're talking about cash flow of premiums. This is not premium accrued. It is actual physical cash flow. Payments to or on behalf of policies, including claims that have already been reported but not yet paid, i.e. reported claims. Incur claims for events that have incurred but for which the claims have not yet been reported, and or future claims for which the entity has a substantial obligation. Talking about in today's AGAP speak, we'd be talking about claims paid, claims payable, pending claims, and your IBNRs, etc. That's effectively what Part B represents. Item C is your insurance acquisition costs. They're typical things like your upfront commission paid to third parties or aggregates if you're using the internet, etc. Claims handling costs, policy administration and maintenance costs, and finally transaction-based taxes and levies, where GST and fire service levy are two obvious examples. But as we were talked about earlier today, and particularly during the one from AASB, this is just, by the way, for those that like things in a more diagrammatical format, this is another way of looking at the cash flows within the contract boundary. And that effectively has all those bubbles there, represents all the cash flows that we refer to in paragraph B65. But it's equally important to understand what is not included in that. And to refer to what is not included, we need to look to paragraph B66. And the first one that stands out is investment returns. The second one there is the reinsurance contracts. And this has been a common theme throughout today's session. You might remember a few sessions earlier, they made a big mention of the implications that cash flows do not include reinsurance. Section C there refers to cash flows relating to costs that cannot be directly attributed to a portfolio of insurance contracts. That kind of makes sense. Income tax, which is treated separately under AASB be 112. And finally, cash flows from separate components. Now, as you might remember earlier today, under the new accounting standard, AASB 17, we need to split out between insurance contracts and non-insurance contracts. Now, in the case of life insurance, there's often a lot of embedded investment style arrangements and investment style products, in which case that's going to be treated separately under AASB 9 and accounted as such. Similarly, a lot of private health insurance products have embedded in them a lot of wellbeing products, things like gym memberships, etc. They've also got to be taken out and they've got to be treated separately under AASB 15. Again, that's a rather important one because that effectively means you can't include the premium that would be included into that. That's got to be treated separately. Okay. Now, what's the significance of that? Why have I just spent the last, a couple of minutes talking about contract boundaries and making a big deal about it? Well, the significance comes in when we refer to paragraph 53. Now, 53 talks about where the premium allocation approach applies. Now, earlier today, we looked at I suppose effectively three key models. The variable fee approach, which applies to when it's participating features. The general model, sometimes also known as the building block approach. And finally, the premium allocation approach. And as we learnt earlier today, during a number of the sessions, the premium allocation approach is by far the simplest. So there's always going to be an incentive for every entity to try and, if they can, try the premium allocation approach. But there's two criteria that are required before we can apply the premium allocation approach. The first one, and this was also talked about earlier today, but it's worth repeating, is that the entity reasonably expects that the liability for remaining coverage, often called the actuarial reserves, would not differ materially for the one used in the building block approach or the general model. I.e., if you were to use the premium allocation approach or the general model, there would not be a material difference. Well, certainly the entity wouldn't expect there to be a material difference. That's item one. Item two, though, is that in the case if the contract boundary is 1 year or less, you can also automatically use the premium allocation approach. Okay. So,
There's three questions that have just come through.
Okay.
I think one of you answered. How does reinsurance contracts with sliding scale premium based on losses fall into this contract boundary?
I would still take, I'm happy for William to come in any time, I would still take into account, so we're talking about, so just to be clear that question, we're talking from the perspective of a reinsurance contract boundary or the gross contract boundary?
It is reinsurance contract boundary, but whoever wrote it.
Because I'm looking for the perspective, because effectively, I want to sort of probably make it very clear that effectively you now have two contract boundaries. You've got the contract boundary for the insurance contract, and then it'll also be a contract boundary on the reinsurance contract. So I wasn't sure whether the question was from the perspective of gross or reinsurance? Reinsurance. So we're looking at saying, so can you sort of talk through, I'm not too familiar with reinsurance and sliding scale. Do you want to talk a bit more about?
You have a sliding scale premium payable depending on what losses have come through.
Yep.
How do you define that? Because you say that if it significantly changed
Yeah.
reprice and all that changes the contract boundary. So how does that fall into that?
So the view that I would say, and again I'm happy for William to come in at any time, effectively you would look at the gross insurance and just treat it as is, completely ignoring the reinsurance perspective and take all the cash flows that included in that. Then you'd look at the reinsurance and in a separate arrangement. So it almost wouldn't matter the type of reinsurance. So as long as the reinsurance contract, so let's say for example there's a insurer and a reinsurer and they've entered into a 5-year agreement, whether it be sliding scale or not, that contract boundary would be over 5 years. And as a result, the entity would need to make the call, would need to do the assessment to see whether there was a material difference between the building block approach or the PAA approach. Does that answer your question? Fantastic. Okay. This one here is a great, was another question, sorry?
How does long tail business, e.g. D&O, fit into the contract boundary as claims will be paid in 8 to 10 years' time?
Okay. Look, it's a really good point. In fact, I want to sort of look into this perspective where we actually go back to the original contract boundary. So Effectively, D&O being directors and officers insurance. I'm guessing that's what they're referring to. Okay. Look, I've got a number of scenarios. I haven't specifically looked at directors and officers insurance. But remember, though, when we look at the cash flow, it also looks at cash flows that happen throughout that particular period. But if you look at the payments to policyholders, it does also talk about future claims which the entity has a potential future obligation. Now, if we think about a sort of a contract boundary, so let's say an entity renews its cover, let's say on 1st of January every year. 1st of January, you renew the cover, you pay the premium, etc. The end of the year, of course, that's going to renew. Now, you're only going to be paying claims that are going to be relating to that period or that are being incurred during that period. So I would say directors and officers insurance would be a contract boundary of 1 year, unless there's obviously other agreements surrounding that. William, do you have any views on that?
Yeah, I think to not get overly focused on the, I guess, the claim element. The key thing is looking at the actual contract terms, when the risks can be reassessed, pricing can be changed, and when can the insurer kind of essentially end that contract. And that's probably, from my perspective, the key elements to assessing a contract boundary. Once that's done, you then look into the measurement of that, which under a general model you'll be looking into cash flows and forecasting them into the future, which be rolling forward your claims assessments and taking it on as a measurement approach, which is, I guess, the next step of the accounting.
Mm-hmm. Sure. And there was a final question?
And there is. So what are your views on practicality, ability compared to what's occurring in practice? i.e. they have the ability to reprice, but practice never enforce it.
We have some, in a couple of slides' time, we have some scenarios. So if you remember that question, why don't we come back to that when we go through those scenarios? Okay. So this diagram here is a really good diagram you can almost use that at the start of any project. Effectively, you want to look at all the products you've got. You want to make an assessment of what the coverage period is. And if it's obviously 1 year or less, then the premium allocation approach is applicable. If not, and as we've seen for some of those questions, there's obviously a lot of subjectivity around that. But if it's not, the next step is going to be to see, is there a material difference, or does the entity expect there to be a material difference between the PAA and the general model? And of course, if not, then the general model needs to apply. If there is a material difference, then the general model needs to apply. Okay. Now, what are some challenges surrounding this whole process? Now, there's a couple of ones there that are definitely worth highlighting. The first one there is materiality, and this certainly came up earlier today with during the actuarial session. Now, materiality is not defined in the standard. It is something that the entity itself would have to make a judgment call. But this is also a time where it's really worth engaging with your external auditors to ensure that your understanding of materiality and their view of materiality is the same. That's a very, very important thing to deal with. The second thing is to look at, if we agree that we've got to do the testing to see whether there is a material difference between the PAA and general model, it's required that the entity examine differences under reasonably expected scenarios. Now, those are not defined in AASB 17, but a really good tool to use, and this was something that was brought up also in the actuarial section, was the Actuary Institute Information Note version 2.0, and it's found on the actuarial website. Now, even if you're not an actuary and don't deal much with the actuaries, it's definitely worth downloading that. There is an enormous amount of information, and as mentioned earlier today, it's a lot less information insofar as theory. It's all about practical implications. It's all about questions, how do you do this, and some responses. Definitely worth doing that. But this is also the time that you really want to be engaging with your actuarial team and make sure that they're on the same page as well as you are. Okay, so what are the benefits of the PAA? Well, the liability for remaining coverage is simpler. It's closely linked to the unearned premium-based model used under most GAAP accounting models. There's no need to derive a risk adjustment for the liability of remaining coverage. And also there's no need to derive a contractual services margin, which is probably the most complex part, as we saw earlier today. In addition to that, there's a lot fewer disclosures under the PAA. And finally, the companies can leverage off the current reserving methodology using the PAA. So in summary, it's simpler, hence why it's called the simpler model. Okay, determining the contract boundary. Now, what we want to do now is to go through a couple of scenarios. Now, at the end of the day, what we're providing to you here is really just some, what we believe it is. When you actually go back to your organisations and start looking at your individual contracts, it really goes down to, professional judgment. So don't use this as a guide only. We've tried to select scenarios from, each of the different industries, but obviously feel free to use your own professional judgment when it comes down to your own individual contracts. Now, let's look at the first one. The first one is home and contact insurance. It's a very, probably more of a basic insurance product to understand. The insurance company underwrites all policies. Policyholders can pay monthly or annually. Policies renew every year, and insurance premiums adjusted yearly at the insurer's discretion. Okay. Now, hopefully this is a reasonably easy one to understand. And of course, going through this process, we need to ask the question. Looking at it from the remote, just to go recap, remember we're looking here at when the substantive rights and obligations ends. And the question we need to ask ourselves is, when does the entity have the practical ability to reassess the risk of the particular policyholder and as a result can set a price or level of benefits that fully reflects those risks? Okay.
So in simple terms, if we're going to do a poll, the contract boundary, would we say it's 1 year or less? For those who think it is, could we put your hand up?
Which is good. That's exactly what we'd expect.
That's the right answer.
Okay. Yeah. There's no way that there's nothing that I could see unless there was something unusual about the contract to indicate that this would be anything more than anything more than 1 year. So as a result, we can use the premium allocation approach. Okay. Let's use one a bit more complicated. Okay. Lender's mortgage insurance. It's a single premium, so a one-off premium. It's non-refundable. It's non-transferable. It protects the bank against any loss incurred. The insurance company underwrites all policies. And probably the most important one there, which is item 7, the actuarial estimate is 20 years to distinguish all risks. So, we want to do another poll?
Yeah. So if we're going to do a similar question, is contract boundary 1 year or less? If you could put your hand up, be good.
Okay, and make sure you're listening. If it was more than 1 year, put your hand up. Perfect. Excellent. That's the right answer. Okay.
And I think on an aside, we call LMI out. There could be other contracts within general insurance, such as construction contracts. So I guess the expectation that all GIs will be reporting under PAA is probable, but there is going to be elements within a lot of portfolios where the general model will apply, and you'll have potentially dual measurement reporting, which I think is a likely position, as most GIs probably won't go fully to the general model reporting for all their contracts. So there is complexity within the industry, and depending on portfolio, you may actually have multiple measurement models to apply.
Okay, cool. All right, the third scenario. Now, the third scenario is a group life insurance policy within an industry super fund. So we're thinking things about your, Hester, CBUS, Hostplus, etc. It's a 3-year group life policy with a rider of total and permanent disablement insurance, income protection insurance. The price increase is capped at 2% per year. What that says is the insurer, the maximum they can increase their premium is 2% per year. There's no underwriting for default cover and underwriting for cover above the fund. So again, from a hands up perspective, anyone think that it's 1 year or less? No. That's a pretty obvious one. The 3 years is probably a bit of a giveaway. But this is an interesting sort of one, and I kind of want William's take on this, because he's done a bit of work in looking at where there are some differences between applying the premium allocation approach and the general model, and where there's ones where actual fact that there isn't a materiality on it. And I thought this would be quite a good one, because this is something that I think a lot of people in the life insurance space would be looking at quite heavily, and to sort of think, okay, how should we account for this? So William, do you want to talk about your...
So probably, this is kind of high-level views. These are, in part, my views, definitely not a kind of a mandated and approved version of how to adopt. I guess the interesting things when we look at group super is, firstly, from an insurance perspective, who's a contract owner? Is it the super fund, or is it the underlying insurance contracts and members? Depending on that perspective, you could then quite quickly go into, this is a 3-year contract, but some have shorter terms where the super fund can effectively retender a whole group of contracts quite quickly. In that scenario, be it 1 year or 3 years, we have seen indicative modelling which would suggest this could fall easily within a PAA measurement model, which, when we're thinking about we're in the life insurance space, is surprising. How life insurers will approach this may be for other reasons. If their book is more diversified, they've got retail and group, they may want to report this under the general model for everything and not take that option to do PAA. If you're a life insurer with predominantly a group book, you could be looking for a PAA reporting. The only question would be, within the market and comparability, does that make you an outlier? So this is a good example where there is options, and it's definitely for the insurer to decide where they want to take, and it's not definitely just because you can do PAA necessarily the obvious choice.
Oh, excellent. We'll just pause for this second. Any more questions come through? No worries? Okay, cool. Okay, the next one. Okay, this is a stepped premium yearly renewable term life insurance. This case, the policyholder is underwritten at inception. The insurance is assigned a risk rating that never changes if the contract is continually renewed. The specific price based on age, gender, smoker status, with specific loadings and exclusions. Non-cancelable renewable. Now, this is a key term within life insurance products, like term life insurance products, where effectively the insurance company can never cancel a policyholder's contract as long as they continually renew. Subsequent premium prices are set by reference to a stepped premium rate table based on age, and the insurer is permitted to update the stepped premium at any time. The update applies to new and existing policyholders. Again, show of hands, 1 year or less? Now that's not a problem. And the recent over 1 year. Over 1 year, fantastic. And a lot of people are undecided. So, yeah. So it wasn't an issue that a lot of people raised their hands. Now, we learned earlier today about that transition resource group. Now, I picked this one up because as the transition resource group made a number of comments, and they initially made an assessment that products like this should actually be 1 year. Now, their logic was that the stepped nature of the increase in premium was saying that effectively they're reassessing risk year on year. So as a result, you can use the premium allocation approach. However, I think we need to look at life insurance in a holistic perspective and really what it's about. I think the most important thing there is, well, there's two probably key important ones there. The first one is the concept of underwriting, and this is also a term used, an argument used by the transition resource group, in the sense that underwriting creates a deterrent to leave your existing insurer. Now, I'm not sure if anyone has gone through the underwriting process when you try and deal directly with a life insurer, but it can be a very long, very strenuous process. Most people don't like having to take medical tests and blood tests and fill out pages of forms. And and after all of that, there's no guarantee you're even going to get coverage. So underwriting creates a gross disincentive to change our providers. The second one there is we've also got to look at the concept of non-cancelable renewable. Now, what that really is sort of saying is that when under insurance, There's only really one time that an insurer can properly reassess risk and adjust by way of benefits or price, and that is basically at inception. That is the time of underwriting. After that time, if someone gets very sick or ill, there is nothing that the life insurer can do about it, and that's also mandated under the Life Insurance Act. On that basis, the Transition Resource Group ruled more in favour and to say that products like this will be over 1 year. And more realistic, you'd be looking at sort of 10, 20, 30 years, etc. A lot of actuarial models will go up to 99 years, depending on the age of the policyholder.
I may just... Yes, so TIG is obviously looking at guidance. I wouldn't say there was kind of clear rulings. And calling this out is probably, it's a judgmental area. The step premium in this scenario does give the insurer the right to reassess the risks and the pricing, of which they could kind of increase pricing to such a point that the insured wouldn't renew, which provides a potential for a PAA reporting if it's within a year. If you look at that and compare that to level, similar rights aren't there within the contract, and that would easily push them into a general model approach. So there is judgment, and I guess for TIG, what they've explored is those areas of judgment, and they provide lots of good examples just to expand on key considerations you should be doing in this scenario, but applying them to other products at the same time.
Cool, that's cool. Okay, the next one. Now, this one is Australian private health insurance. And a lot of Australian private health insurance is sold through iSelect and Compare the Market. These are often called internet aggregators because there's an enormous number of private health funds that are on those sites. Now, for those of you who are not from a private health insurance background, there's a couple of things that are quite unique to private health insurance. It's worth calling them out, though, because now that you have one type of accounting standard that applies to all types of insurance, even though you may not be working in that, the principles still apply. So there's a couple of things that are unique about Australian private health insurance. The first one is that insurers are not permitted to underwrite or refuse coverage. That means it doesn't matter how well or sick, how young, old, smoker, non-smoker, it doesn't matter about that. They have to take your risk on board. They have to accept your premium and your coverage. Another unique feature of private healthcare is the concept of community rating. And what that means is that price may not be varied by age, medical condition, or other factor. So not only can a private health insurer not underwrite, it doesn't matter if someone is, again, young, old, fit and healthy, or not so healthy, they pretty much pay the same price. There's no reinsurance in private health insurance, but there is risk equalisation that applies. And if you're going to the breakout session tomorrow, this will be an area that's talked about, because that creates a whole new level of complexity in relation to private healthcare. There is loading that's applied. The insurers may change their prices within 6 weeks with notice to the regulator, and normally prices increase on the 1st of April every year. Some of you probably see enormous amount of advertising for iSelect and Compare the Market around about early to mid-March. And because what they're trying to do is, as the prices suddenly increase, they're hoping to try and get some turnover in some of their sales. And another key thing that is very, very unique to private healthcare is that the regulator has to approve all price increases. Okay. Now again, show of hands. Who do we think thinks it's 1 year or less? Put up your hands. Okay. And those who think it's more than 1 year. Okay. Now, that was a very interesting one that also the Transition Resource Group made some comments on. You see, the issue that stands out there is the concept that the regulator has to approve price increases. So if you think about that for a second, the whole concept of AASB 17 paragraph 34 is the idea that the entity has the practical ability to reassess risk by way of price or benefits. We know that they have limited impact on benefits, but if their price is capped, and some of you might remember at the last federal election, Bill Shorten promising that he would cap increases in private healthcare to 2%, and all the private health insurers were quite concerned because that meant they really had even less flexibility in terms of their price increases. There was a strong argument made to say that because of the regulation on price increases, effectively AASB 17, paragraph 34, had some problems, and as such, the contract boundary would be over 1 year. But that's got to be offset by, I suppose, two key concepts. The first key concept is the fact that there's no underwriting. Now, a moment ago, I mentioned to you the importance of underwriting in regards to term life insurance. It's a disincentive to change. But there's a real incentive to change if you're in private healthcare. And this is often what happens, and again, this is why there's so much advertising by private health funds around about mid-March, because anyone can change. You can't discriminate based on price, and you can't discriminate based on underwriting. So effectively, it caps things at 1 year. The second thing that the Transition Resource Group brought forward was a concept that at the end of the day is the nature of private healthcare is short-term in nature. So people all the time are going to get sick. They're going to go to hospital, or they're going to get new glasses. They're going to need, dentists and fillings and etc. But this is all short-term in nature, and this is something that when the actuaries are looking at the product, they're going to be and looking at the pricing. They're going to be looking at things on a short-term basis. They're not going to be looking for benefits over 1 year. Now, in addition to that as well, and this just shows actually who was also looking at the earlier slide in relation to APRA. APRA also made the comment that they expect that private health funds will all have a contract boundary of 1 year. Okay. Anything you want to add to that, William? No worries. We'll go into the last one. Last one should be a bit simpler. Compulsory third-party insurance, compulsory for all motor vehicles, not permitted to underwrite or refuse coverage. Prices are regulated such that the insurer is only allowed to set one premium rate according to the vehicle classification and geographic location. Cannot be varied by driver's history. Price settings will have regard to their experience and the cost risks they anticipate in their portfolio. Same as before, 1 year or less, please raise your hands. Yep, and I'd agree with that as well. Yep. Okay, any questions that have come through? No worries, fantastic. Okay, issue with the contract boundary. Now this is something that again has come up throughout today's session, so I'm not bringing this up for the first time, and that's the fact that you have cash flows do not include reinsurance. So effectively you have this problem where, let's put it another way, you have a potential problem where your gross insurance and your reinsurance have totally different contract boundaries. And this means effectively you can have totally different actuarial methodologies the way you account for either gross or reinsurance. You could have, as we looked in the first example, home and contents insurance, it's all 1 year, we agree with that. But you may have a 10-year agreement with a reinsurer like Munich Re, Swiss Re, etc. Alternatively, in relation to your term life product, if it's assessed that the contract boundary is 10 years, but you have a rolling agreement with a reinsurer, again, you've got 10-year contract boundary on gross. Reinsurance, the contract boundary will be only 1 year. Cool. Excellent. So, as I mentioned earlier, we're looking at not only the contract boundary, but also the level of aggregation. To that, I hand over to William.
Thank you, Michael. Level of aggregation, I'll step through. So the key thing on this slide is, it's increasing granularity. The key impacts of the level of aggregation and the increase of granularity is significant impact on your modeling and data requirements, which should not be understated. And the other one would be the volatility in profits, which we'll talk to later on, but due to the increased granularity, there's a higher likelihood you will have it will flow onto your P&L, mainly due to the owner's contract or portfolio recognition. In the blue boxes, they are the main components of what we're calling a unit of account under IFRS 17. This is a good graphical representation. So we've got the unit of account, and I like to think of it being made up of three key elements. The first one is the portfolio, and this is where we're looking at a group of contracts manage or similar risks managed together. And that's the kind of key concept we'll go through in more detail, but that's where you start with assessing your level of granularity. So you identify that and you start dividing your insurance contract into these types of portfolios. The next element is you then have to do this kind of profitability test. And that's looking at, the key categories would be onerous or profitable. And within that profitability section, you have to split out a significance, which it's a principle-based standard, so it's not explicitly explained how significance should be determined. Again, a key judgment area. Then the next element would be you have to kind of group at a minimum your portfolios into annual cohorts. So all of this comes together to create your unit of account. We'll step through, I guess, each of these concepts in a bit more detail, but the key message is there's increased granularity and complexity this brings. So this is a very simple, I guess, example. Under one, we've got 100 identical contracts written with a probability that five of them will have claims. So in that scenario, very simply, we'll have one group because there are 100 identical contracts, so we can assume quite safely it's similar risks managed together. If we step to scenario 2, we've got 500 contracts, but we know 200 of them are loss-making. We can explore how do we know about those onerous contracts. So if we take as a given, this is a scenarios where we'd have two groups. There may be similar risks managed together, but because of the profitability test, we've then had to split them out. Very simple. I won't stay too long on it, but that's kind of what we're doing. But as you can imagine, if you think about your own portfolios and your insurance clients, doing that, can you do that analysis today that quickly? Probably not. Again, data requirements. This slide talks to, I guess, the growing complexity. So in the left-hand corner, we've got example portfolios. We've got 2 portfolios, an open book, closed book, and we assume the open book is a monoline piece of insurance, car insurance, and that's what it is. If we step through to the grouping of contracts on annual cohorts, actually change it from a car insurance contract to a standard life contract, so it's multi-yeared. You can see, each year you kind of have to capture the same level of information, but segregate it per contract, which then has the associated modeling and CSM release. This obviously pertains heavily to life insurers or people reporting under a general model. As we flagged earlier on, general insurers will be caught under this with either some direct types of contracts, but potentially and more probably under their reinsurance treaties, which when visited often, you realize it's a 10-year contract, there's multiple terms, it's not that easy to get out of, and suddenly you're accounting for your reinsurance contracts under the general model, even though all your direct business could be under the PAA. Yep.
Please explain what annual subdivision comes from and your interpretation.
Annual subdivision.
I just asked. I don't know if it was on the last slide.
Oh, so if we, I guess, step back, so if you can see period on the, so it's a requirement to account into annual cohorts at a minimum. So every time you've got a group of contracts, you have to group them together, assess their profitability, and you have to essentially keep that grouping on an annual basis. So they all need to be within the same 12 months. So contract boundary. So it will be driven by your contract boundary.
So cash flows within each of those.
Yep. So this kind of highlights maybe the 3 key paragraphs within the aggregation section of IFRS 17 I would call out. Probably key things to mention would be paragraph 14, which looks at how you group your portfolios. I guess the general expectation, what we've seen in the market is definitely if you've got currently roughly three groupings internally if you're reporting, that is probably not going to stay under IFRS 17 because with increased granularity analysis, you'll probably realize the management of those contracts, the risks associated with them would need to be split up. So you are expecting increased portfolios under 17. The next two, I guess, key paragraphs, the key call-outs would just be, I guess, the data and operational impact. So, do you clearly have, on a portfolio level, an ability to identify profitability straight away and an ability to group them in those annual cohorts? If not, that suddenly, if you've got an implementation project, that becomes a data requirement, new process creation task, 1 and 2 to start investigating to explore further.
Sorry, William, we just had one question just on that slide that's popped up. Do you think the requirement to recognise onerous contracts upfront is counterintuitive to the mechanism inherent in insurance industry of risk pooling?
I guess the tension where that question I'm guessing is coming from is obviously insurance. There is an element of cross-subsidization. You group, you don't make profit on a single contract necessarily. You assess a pool of risk and you underwrite according to that. What the standard is trying to push insurers more towards is actually doing a more detailed transparent assessment and reporting of that. So a classic example would be income protection in life insurance. That's been a loss recognition for a while. I think if we had IFRS 17 6-7 years ago, that probably would have been seen earlier under the accounting. And that's what it's getting towards. So it's not, the risk with this adoption is you go to too low granularity and then you have lots of onerous portfolios, and that's a judgment and I'd say a key area to avoid. So, yeah. So on the topic of, I guess, of onerous contracts, this slide will be obviously made available. This is just looking through how you go through a step-by-step approach to look at a high level your groupings and the profitability. It's been mentioned a few times. The key flag here is just because you identify an onerous group on your direct book, your reinsurance can't be offset to net that off in your P&L, which is why we talk about volatility in your P&L. The ISB ED, as mentioned previously, has discussed and tacitly accepted, including an amendment which includes allowing proportional reinsurance treaties to be netted off and recognised in your P&L to avoid that. There has been from the WSB TRG further, I guess, requests for discussion on expanding that requirement so more reinsurance treaties can be factored in. That's obviously an ongoing discussion. So the big call out here is, there's going to be more onerous write-offs under 17, and your reinsurance treaties won't be able to just net it off. So consequence being to your reporting is, greater volatility. PAA, interestingly, doesn't. What's the wording? It's at inception assumes no contracts in portfolio are onerous unless facts and circumstances otherwise indicate. So I guess the key idea around that is under your general model, you'll be calculating all these future cash flows and compiling it'll be pretty evident what is and isn't onerous. Under PAA, the ISB is given a bigger remit to, unless there's facts being presented, you just assume there aren't. And those facts are judgmental, so be your internal reporting, pricing, analysis, and what you do internally to help identify that. Once identified, you would then probably need to do further analysis to determine what group portfolio is onerous.
Sorry, 2 questions off the back of that. 1 just popped up. Is there any real difference in how unlikely to be profitable and no significant risk of becoming onerous are accounted?
Operationally, there will be, because you'll need to track and monitor that internally. From reporting, I'm not aware of any explicit disclosure of Yo's bucketing. How you determine the significance test is, and what is and isn't, significantly, is, a judgment area which, needs to be analysed, explained, documented, and kind of reviewed by all stakeholders. Key one being your external auditor to make sure they're happy, would be
What have your clients been determining as the facts and circumstances that identify onerousness?
So I briefly mentioned it. It's pretty wide, and one of the presenters earlier did, describe it nicely. It's not a witch hunt. So it's based on, your own internal reporting, analysis, and assessments, which you do for, non-statutory reporting basis, how you manage your business. If as part of that product review or pricing review, certain deficiencies are identified, then you do further analysis. If part of your management, so it's management information. It's kind of what you use to manage your business. If something pops up which would indicate that, then you do further analysis to see if there's an erroneous write-off, which isn't too dissimilar to, the current requirements and how we manage kind of write-offs currently.
Next one, paragraph 40B says the liability of incurred claims relates to past services allocated to the group at that date. What does group mean, and do we need to allocate? Two past services allocated to the group. I don't know what the rest of the paragraph is. That's the extract. I don't know if we have that somewhere, if that was on a...
Paragraph 40. If it's about allocation...
Assume it's 40B. What was it?
Not knowing the paragraph off the top of my head.
I don't know who said that. I don't know if that's a specific slide that was in reference to, or if it's just a general discussion. Maybe on that one we can come back to.
Yeah, but I guess the main point with allocations, the ISB has given remit to, allocation from bottom up should be done where relevant, and that's kind of going from detail. But when you do have kind of overheads and those types of expenses, they do need to be allocated, and they've given the remit to essentially allocate those types of expenses at a higher level of aggregation than a group or portfolio, which would then go into how they're being actually modelled and stuff like that. So that remit's being provided to essentially reduce operational complexity and cost, because a part of the overall valuation, that extra allocation wasn't perceived to be massively beneficial. When you think about it, if it's an estimate, if you're aggregating a high level, it doesn't really add that much more to drop down to a profitability bucket and stuff like that.
It was under the subsequent measurement of the standard.
Yeah. Yeah.
If you set your level of aggregation 1 year and then realise that it's probably not the best way to do it, or that your business changes, can you then in the next cohort change your portfolios?
Yes. It would be an accounting policy change. You wouldn't go back and amend but yes.
Would it have to be a business change, or would it have to be just, that's probably not how we manage our business? Really, we typically think about it. Do you know what I mean?
I guess a risk, so it could be a misstatement, because and then there's an accounting standard which prescribes how you would go back about restating financials if there's been a material misstatement due to an accounting policy choice which was wrong, or if it's a re-estimation, then you'd kind of more prospectively apply that change, and you'd include additional disclosure in your financial statements explaining what's changed as part of assessment prospectively. So it's all the same assessment, and I'd point to that error versus estimate standard, which would advise you how best to approach that in relation to 17 and level of aggregation.
One more question. Why did the open book portfolio not have an onerous contract? If there is no probability of losses, risk sharing, would a contract be an insurance contract?
So this was just an example. I think in the third year they did have an onerous book. And what was the second element of the question? So it could have done. This example just didn't have any. So potentially, you do your groupings, and there isn't an onerous bucket. So we're thinking there will be some when you go through this process, but it's not 100% required. You will have portfolios which are onerous. However, in this example, you can see in the third year, an onerous bucket was identified for whatever reasons. And there was a second element to it.
If there is no probability of losses, would a contract be an insurance contract?
No probability.
Are you sharing? Would a contract be an insurance contract?
I guess if there's always a probability loss for an insurance contract. It's a short answer. You'd expect to pay claims out and stuff like that. Without a specific example, if it's not an insurance contract, then it's a social good with which is then just an expense or liability.
At what steps is it the eligibility of PPA tested? Is it tested for each group or contracts identified in step 2?
Step 2. So you have to do this is PA eligibility.
Yeah, it's just come through then.
Yep. So there's not clear guidance on the frequency of how often that assessment should be performed. You obviously got to do it at the start. I guess the main question would be agreeing a frequency in keeping with the changes of your underlying portfolios and contracts. So if certain products are fundamentally moved, that would spark a new assessment. If nothing has changed, then an eligibility reassessment and modelling, you would look to do it, maybe, and this isn't, could be once every 3 years, annually. That would be your accounting policy choice, dependent upon risk and perhaps the maturity level. So if it was a kind of the materiality in comparison to general model was pretty tight and it just got into PAA, that may drive an annual assessment to monitor that. If it was a pretty immaterial difference and the product is pretty simple and won't change, you could develop an accounting policy for a less frequent reassessment. Again, you need to kind of document and get all stakeholders across that. So this is a very simple example of, I guess, the impact of grouping and level of aggregation. So example 1 is 2 contracts which, for whatever reasons, are treated separately due to they're not managed, not similar risks managed together. By not grouping them, the impact is there's a bit of volatility in year 1 in your P&L, and then the profit or the income or profit in this is recognised year 2 and 3, and the contracts are separate. Example 2, these contracts are now similar risks managed together. They're grouped, and what this slide is purely getting at is by grouping, it can help reduce volatility depending on how, and it all comes back to the judgment of where you set that level of aggregation. So the level of aggregation does have a significant impact to your operational processes, data requirements, but also to ultimately what you are reporting. This is very simplistic, but if you set the level too low, you may introduce a lot of volatility. If you set it too high, it may not pass your major stakeholder test because you couldn't justify it. So that's simply all it's getting at.
One question.
Okay.
How would you treat endorsements for, say, an extension of a construction risk? Would that be considered separately accounted for from an initial contract?
So I suggest, I'd point you to this, there is a whole section within the standard about dealing with, is it an endorsement to the contract, or do those changes amount to a new contract being performed? It's very specific, and I would just follow those steps basically, and that would, an endorsement, you'd have to get into a detailed example what it would look like if it then would create a new contract, or if it creates the contract boundary wouldn't change if it's a endorsement of just an additional benefit, but the terms are still there. So it's hard to prescribe. I would suggest that the standard's pretty clear on that. So we've got till 8 minutes. So I'll quickly go through this element. So some, I guess, key considerations around unit of account would be, the importance of determining the unit of account and level of aggregation. 2, the impacts to the system and your accounting. I think I've kind of don't want to labour a point, so that's clear. This is probably for those in insurance groups quite important. So this underlines the complexity. If you've got a number of insurance subs and you aggregate them into a group, your level of aggregation, lots of questions pop up. Is it a simple roll-up of your subs portfolios to a group perspective? And as you can imagine, if you've got multiple portfolios split by profitability and annual cohorts in one sub with multiple products, and then you have to aggregate all of that, that becomes quite, from operationally, a complex process. Another aside is some groups, and this isn't a right perspective or wrong perspective, also say, well, from my group global perspective, what I treat as risks and manage together is very different to my sub. And do I have a different level of aggregation in different portfolios? We're not going to answer that question now in the next 8 minutes, but if you are in a group, that's probably a very important area to get a clear view on, because it would have significant impact to what you're reporting, impact to how you're reporting it, and if you do have a view that your group perspective is different with different level of aggregation, you will have 2 books, which again introduces more complexity. Again, it's a question, not a clear answer, but plenty of work to be done over there for insurance groups. So we're coming to the end. So why is aggregation so important? Impacts your profit emergence and what you're reporting. Operationally, how you model it, what you need to model, the data you need to obtain has a huge impact to that. The higher the level of aggregation, operationally, it's simpler to adopt. The lower level increases complexity. And then the financial reporting impacts from group reporting, additional disclosures, etc. So for final thoughts, I guess if we look at all the specific terms we've covered, it's pretty clear that identifying these key decisions early and starting discussion and building a view on these areas is really important. Early engagement with all stakeholders, and stakeholders include your external auditor, but your board audit committee, investor relations, there's management information. There's a number of people who will be impacted to the new form of insurance accounting, and getting their views early could help drive policy decisions, but also the implementation side of, well, we may not need that level of detail for statutory reporting, but the management information guys may want it for other purposes. So from an optimization perspective, as part of implementation, you may want to factor in all these things, to get the most bang for your buck. The next step would be clearly document all of this stuff. So we've uncovered a number of judgments. The scenarios we went through, not all of them are clear, and you can have different positions on them. The key importance would be outlining those positions early on, making it clear, making sure everyone's signed off on them, just so later on it's a clear picture, and then any build and implementation which happens after that can go back to these kind of clear tools. I appreciate the standard is, there are elements of standard which are in flux, so we do need to be agile, but there are 90% of standard is it's not going to change, so we've got plenty of time to make decisions on stuff now. And that's probably it, and clarity above will help your implementation journey. So yeah, that's it. Any questions?
Just one on RE groups grouping similar policies by similar risks. For building insurance, would you separate a group of higher cat risk, e.g. North Australia policies?
How you manage price and underwrite that stuff. So it would be the insurer to decide those types of questions elsewhere.
And there's just the other one from before. What are your views on practicality compared to what's occurring in practice? Any thoughts?
Practicality, I would say for life insurers, there's a lot of granularity requirements. General insurers, if you had maybe you don't have portfolios now, but say if you broadly had 3 big buckets, that may be 6 or 7 now. This is high level. This is kind of what we're seeing within the industry. If we went back, 6 years ago, some people were talking about, I've got 1,000, portfolios. So I think there is normalization, and it is kind of getting to a sensible position. But again, if we go back to documenting it and having it written down, I think the process of doing that, if you do have 3 buckets or portfolios, and when you go to document it, all stands up, great. When you go to document it, it doesn't quite hang together. The process of doing that really helps kind of outline your position, and if it's 3 or if it's 4, it's not a significant matter at that point. Cool. Thank you.